this on this computer. Okay, let me start over. Hey y'all. Happy
Hey.
Tuesday. Thank y'all for joining us today. So today we have my good friend Zoe, Zokpia Olumese. I used to love to say that. Okay, anyway, so we went to college together at A&T, graduated accounting. He went on to get his master's at Michigan State, and soon then went on to start at Deloitte & Touche in Arlington, Virginia. McLean, Virginia. And now, while he was at Deloitte, he passed his CPA, and he was like, peace out, Deloitte & Touche. And now he's doing big things as the managing partner of his own accounting firm. So I'm going to pass it to Zoe so he can have his full time and you guys have time to have Q&A. Zoe?
Cool. Awesome. Hey, everybody. I just want to introduce myself one more time. My name is Zokpia Olumese. As Ashley stated, I am the managing partner of Otaigbe Olumese CPAs, aka O&O CPAs, because I know that our last names can be kind of a mouthful. But Ashley, if you can do me a favor and pass me over the host, I prepared like a presentation.
Yep, we'll do. Hold on 1 second.
Just to go alongside with what we'll be discussing and talking about.
If I make you co-host, do you still have the share capability?
I believe so, yeah.
All right, I pass it to you.
All right.
Yep.
So I assume you all are able to see my screen?
We can.
Full screen, cool. Nice, this looks cool. Oh, is it actually annotating my words?
Yes.
That is cool. I didn't know that was a possible. That was, okay, technology. All right. So yeah, again, thank you, Ashley, and everyone of the Young Moguls team group for having me. Again, my name is Zokpia Olumese. I'm a CPA managing partner of Otaigbe Olumese CPAs. This is me and my partner, Anthony. We are the primary lead partners on our team. We do we're a full service accounting firm, helping small businesses and medium-sized businesses handle accounting work, tax work, and including auditing work as well. We've had an opportunity to work with a few nonprofits in our day, and continue to consult people on a regular basis. So if you ever need some services, you ever need your taxes done by some trusted millennials who are bright and have a super bright future, we are definitely your number one choice. All right, so I figure that the group Young Moguls is kind of a masterminds group where you all talk about different professional development topics, or maybe some investment topics, maybe things to help just professional development things so that you can get more information in pursuing your goals. And so when Ashley reached out to me, she gave me a couple of topics that seem to be of importance. Those things include business structures. Those things include real estate investing, tax advantages. Those things also include the gig economy, and I think there's one more, business. Did I say business structure? But we'll see it in the slides. So we have a good amount of talking points. I think talking through all of it will take a lot of time. So I really want I'm opening the floor for questions as we go, unless you don't want to do that, Ashley.
No, Q&A, we can flow how you like. You can stop in between,
Okay.
ask questions.
Yeah, because some of the topics don't necessarily flow cohesively to each other. They're kind of separate. So I definitely want people to ask questions and we can have a discussion. Yep. Do I know every single thing? I'm going to be honest and say no, of course not. But my job is to be able to find those answers. So I'll be taking note of questions that aren't answered today, and hopefully I can send it out to Ashley to get the answers to you all later.
Sounds good.
Cool. Awesome. So the first thing we're going to talk about is business structures. Business structures can be broken out into two categories. Those categories work simultaneously. So there are business structures that are purely and solely legal structures, and those structures can also be tax structures, right? So normally when someone says, "Oh, I want to start a business," they say, "Okay, let me go find my accountant and start an LLC." Right? But an LLC, in fact, is actually just a legal structure. It is a structure that helps limit your liability. That's literally what it's called, limited liability company, right? But in terms of for tax purposes, the only structures that the IRS actually recognizes is sole proprietorships, partnerships, and then S corp and C corporations, right? The distinction between the distinction between an LLC and the others don't actually exist from the IRS's perspective, right? So if you are a single member LLC, you're the only owner of the LLC. When you file your taxes, the IRS is going to tax you as a sole proprietor. And if you have two members or more and you file your taxes, you're going to be taxed as a partnership, right? That sole proprietor and that partnership, even if you have that LLC structure, those things are, the reason that is the case is because that LLC structure is known as what we call a pass-through entity. It's simply just a mask that you put on for your business or for whatever operations you're working on. But when taxes come around, that veil is kind of removed, and all of your income, expenses, and things and tax liabilities flow to all of the owners. Does that make sense?
Wow, that's eye-opening.
Yeah. So that when you see it from that perspective, sometimes in a way it kind of devalues, oh, why should I get an LLC, right? I can just be a sole proprietor, because there's really no requirements for a sole proprietor for you to start doing business that are on a federal level. The only requirements that I have seen from my experience come from the state level, and that comes from the state level. So in Maryland, that's where I'm located, primarily located, although we do work in many other different states. In Maryland specifically, if you wanted to work as a sole proprietor, you would have to register your legal name, like your full name, and then you would have to register and purchase a doing business as for your personal name. So when you register your name, you're going to receive like a identification number that I've been registered with the state. Then you purchase a DBA, doing business as, and then you can name whatever you want. I can be Zoe times 2 company, whatever. But if you don't want to go and purchase that DBA, you're fully capable and allowed to use your government name in however way it looks, without any registration, without having to file a DBA. And that's where you see that the sole proprietor becomes free, because you can file and register your name for free, but the DBA does cost a filing fee. And that's specifically in Maryland.
I have a question.
Yeah, what's up?
So I should know this, but I'm just gonna lean on you real quick.
I learned a lot after I left.
So with the LLC, right? Because I literally just went through this process, so I'm trying to wrap my mind around it. It's the same in Delaware, just FYI as well, if you file there. So if you have multiple DBAs that fall under your LLC, right? So like the multiple DBAs would act as like a subsidiary, essentially, right? But does it have it uses all the same federal ID number, right?
Yeah, so I'm gonna say, like, the DBA isn't a subsidiary, like in the traditional sense of the word. Like when you have the DBA, company B, and then company B is a DBA for company A. That makes sense, right? So company B, if it's a DBA, is not its own company. It's just a name.
It just all reports back up to the LLC.
Yeah, it's just literally just a name. It's like I'm changing outfits. That's what it's like. So legally, when you're doing like your taxes and your accounting, you may not even account for that other name. Maybe you keep count of that name for your own accounting records or management reporting. But in terms of reporting to the IRS, the DBA doesn't really, is not going to hold any weight. It's the LLC or the business, the official business that you had registered.
So consolidated.
Yeah, correct.
Yeah. Okay.
So Zoe, can you run a real estate under, say you establish the LLC and have a real estate, some, a restaurant? Can you do all of that under that one LLC umbrella as a DBA?
You see, the answer is yes and no.
Okay.
I mean, you can technically, but you're gonna really have to have some precise accounting, because
Okay.
when you report, because you run into the issue of when you're accounting for every single transaction and being able to split them between the different lines of business.
Okay.
Now, if you are to be preparing for an IRS audit, they would want to see what is your business, what do you do, and why are these expenses and income like qualified? Why are these qualified expenses for just that business? Now, if you have multiple business that are commingling, that causes a big issue, and then you might lose some of that. The IRS may penalize you for doing something like that, right? So there are certain businesses, and I think it might be state regulations, and this is things that require deeper research. There are certain businesses that are legally cannot do that. You have to actually create another LLC to have that. All right. So my suggestion is that you keep it, if you want to save money. My suggestion is you can still do it under one LLC, but keep it very separate. And then when you file your taxes, there's going to be you either have one of those businesses reporting with the EIN number, and then the others reporting as as a sole proprietor under your Social Security. Just to keep it safe.
Clean.
Yeah, keep it real clean.
Thank you.
No problem. So yeah, where was I? So that's LLCs, that's partnerships. Actually should have gone to LLCs, and then there's S corporations and there's C corporations. There are many other, like a number of other types of formations, like business structures, but these four are the most popular ones. You have some you have one that's like an LLP, which is a limited liability partner. You have PLLCs, which is professional limited liability companies. That PLLC is reserved only for like law firms and CPA firms who decide that they want to go that way. So it just depends on the structure, but these ones are going to be your most popular ones. That's ones that are being used. And if you understand these ones, you will reasonably be able to understand the nuanced differences of any other one that you might run into. So we're going to talk about the LLC structure, the pros and the cons of those things. You spoke about how the LLC is a pass-through entity, meaning that all your income and all your expenses are not going to be taxed on the corporate level, because it's for tax purposes. The IRS just disregards it. They look right past it and look to the owners. All right, so that's actually a tax advantage. So you're only going to be, all your income and expenses are only going to be taxed one time, and that's when it hits you on your personal return. The LLC is also the most flexible business structure, because there's not a lot of requirements in terms of setting it up. And there's not a lot of requirements in setting it up, and then you don't have a lot of regulations in terms of operating the business. Like oftentimes, if you want to make a business decision or anything, if it's in your operating agreement, you can go ahead and do that. In the state of Virginia, they have no limitations or no restrictions. It's really fully up to the owners. They do whatever they deem fit, as long as everybody agrees. Now, when people don't agree, that's when you start seeing some issues, because things aren't written down, things aren't written down and nothing, and then decision making can be a little shaky, right? Within LLC is also when the structure itself ends if one of the business owners leaves. right? So the company itself is vulnerable to one of the owners either leaving or even passing away. So you have to plan for your succession plan, definitely for your LLC. We're going to move on to the more complicated structure, which is an S corporation. That type of business structure is recognized in the eyes of the IRS as well as, and is also a legal structure, right? So no, is it a legal structure? It can be, but for the most part, whenever we see people have S corporations, is only on the tax perspective, from the tax perspective, right? So some of the biggest one of the biggest pros of having an S corporation is the fact that the owner of the S corporation is able to avoid certain self-employment taxes, because of their ownership and employee status. So they wear two hats, right? You can be an owner, you can also be an employee, right? So the benefit comes from how you pay yourself. So you know what Social Security taxes are? That's taxes for what are they called again? Social Security and Medicare. That's the word.
Medicare.
Yeah, those two taxes that account for about 7.2% of your income from every time every time you get a paycheck. The employer always withholds those two taxes, right? So when you're self-employed and you have an S corporation, you are able to pay yourself as an employee, and when you pay yourself as an employee, you withhold those taxes. But the income that you're also able to make withdrawals from your business as distributions to yourself. If you have an S corporation, those withdrawals are not going to be subject to that self-employment tax. And that's where the huge benefit happens, because if you have an LLC, you're going to be subjected to both the employee side of the self-employment tax and the employer side of the self-employment tax. But when you have the S corporation, you shield off the employer side of the tax, and only are subjected to the employee tax. Does that make sense?
Yeah.
So if I had 100,000 in my business, right, and I say, okay, I want to pay myself all 100,000. I say, okay, I'm going to make 50,000 payroll for myself. I pay myself through payroll, W-2, blah, blah, I'm an employee. But then the remaining 50,000, I simply just make a transfer out of my account. Now in my accounting, that second 50,000 is not going to be taxed as self-employment income, but the payroll income is going to be subjected to self-employment tax. Cool.
So the piece that you don't, the remaining balance that you did not use to pay yourself, what taxes apply to that?
That's
State
just going to be
federal taxes.
Yeah, that's just going to hit your normal tax bracket,
Okay.
where you are normal tax bracket, but that self-employment tax is actually separate from all of those. So owning an LLC or running a business in LLC can also be a little bit tax costly because of that self-employment tax. You're going to be paying both sides. And that's why people, when businesses start to grow, they really consider and opt into going into the S corporation because it's a huge tax strategy, right? The only things that prevents businesses from wanting to go to the S corporation status is one of two things. One is that you need to be an LLC first before you can be an S corporation. So that's where the value of the LLC comes back into play. That's where you start seeing the tax benefits from an LLC when you upgrade to an S corporation. The second thing that prevents people from wanting to go to an S corp is that they have to fit the cost of a payroll software. So it's required for you to keep track of payroll, make the necessary withholdings for yourself, and remit that to the state and federally, and then to also file your end of the year payroll tax forms. So that can also be a cost of overhead cost that some businesses aren't accustomed to, or now that they want to add on to their books. The third thing that prevents people from wanting to go to S corp route is the fact that when you file your taxes, you're no longer going to be filing a 1040 or a 1040. You're going to be filing an 1120S, and that return is much more complicated than 1040. So your tax professional is likely going to upcharge you for having the S corporation in that regard. So I would suggest, and from what I've seen and heard and have read upon, is that you start seeing businesses switch to the S corporation around. It starts to make sense for businesses to start switching to the S corporation when they're making a little like over $40,000 in a year. That's when you start seeing the tax benefits actually come into play, because you still have to fit those overhead costs, right? And so on our screen, you probably have already read, but there are some restrictions on how you can actually become an S corporation. Those restrictions are one of many, like being a domestic corporation. You cannot have any foreign partners. Everyone must be U.S. citizens. There can be no more than 100 shareholders. You only can have one class of stock. So if you think that your company is about to grow and then go public one day, maybe an S corporation isn't the formation for you, because you want to sell stocks eventually, right? And then an S corporation cannot be owned. I think it cannot be owned by an LLC. Yeah, it says right there. Ownerships cannot be partnerships, corporations, or non-resident alien shareholders. So LLCs that are multi-member LLCs cannot own S corporations. Partnerships cannot own S corporations. So yeah, that's pretty much all about S corporations. Does anybody have any questions concerning that?
So you can have a real estate trust under S corp. I see you have
Yeah.
certain trust.
Yeah.
Okay. All right.
Yeah. Have I seen it? Not yet, but this is directly from the IRS page. So yeah, there are certain trusts that can come on there.
Thank you.
Is it possible to have an LLC? Because I think I was reading this because I just actually started my own LLC. Mm-hmm. But I was wondering, is it possible to, once tax time comes, if you have an LLC, can you tax as an S corp?
Yeah, and that's how you make the S corp distinction. So you would file. So you have to file an election form with the IRS to be taxed as an S corporation, right? And that form is going to have to be filled out. On normal occasions, it has to be filled out by March 15th of the year going forward. So if I wanted to file an S corp as of for the year 2020, I would have to file the S corp election by March 15, 2020. However, there are, the IRS is very lenient in terms of accepting people's election forms. So oftentimes you can do it anytime throughout the year if you just if you send a reasonable explanation of like, okay, I didn't know I needed to do this, so I'm doing it now. And oftentimes they would accept it. Now, during all of this quarantine and COVID business that's happening, their processing is very slow. And that form is not an electronic submission. You actually have to mail it in. So that kind of sucks. So we'll see how the timing of all of their deadlines for all of their type of forms shakes out in the new year. But that is how you become an S corp. Okay. Next one I want to go through is to a C corporation, right? So C corporation is a C corporation. It's probably the most robust business structure out there. It has the most requirements, has the most maintenance, most legal requirements, is most expensive, is the most complicated to form. And this is where this type of formation you see amongst larger companies or companies that have foreign partners, because of that, that availability there. The biggest pro that I know of S corporation is the ease of transferability, as well as the perpetual existence. So if one of the owners were to say they don't want to be a part of it anymore, or they were to pass away, the business stands by itself. It's literally, I like to think of a C corporation as you creating an invisible person on their own, right? So you and your owners created this individual person. So if I was no longer here anymore, that individual person was in that invisible person would still be in existence. That's what a C corporation is. So if you see it that way, you will understand the other concepts of the C corporation. The ease of transferability is only related to the stocks. So if you know, so we all know the S&P 500, the public market, right? You buy a certain percentage of the stock of a company and you have that type of ownership. So we're buying percentages of ownership of this invisible person we just created, and we're distributing it to the different owners. If we wanted to switch ownership, and you wanted to own 100% of it, you would simply buy my shares. And that's how you own 100%. Understandable?
Yes.
Cool. Now, the disadvantage of having a C corporation is the concept known as double taxation. And we said we just created this invisible person, right? So that invisible person also has, the IRS considers them another person. So that person is going to make income, that person is going to spend expenses and then make a profit at the end of the year. And their profit is going to be subjected to taxes to the IRS first. Now, when that person says, okay, that person needs to now make payments of dividends to the owners that own the shares or the ownership to that person. Once those dividends hit the owners, you're going to be taxed again the owners are going to be taxed again on that same income on their personal tax returns. So the income is taxed twice because the C corporation is its own standalone entity. That makes sense? Kinda. So yeah, so that's one of the biggest disadvantages with the C corporation. So when clients come to us and they say, "Oh, I want to start a C corporation," we always pump the brakes and just say, "Okay, do you understand what you're actually asking for, and does it actually make sense?" So it really just depends on the circumstance. Depending on what business structure, you always got to think about your circumstance on what makes sense for you. What makes sense for your business? Where is your business going? What kind of business are you trying to grow to? What kind of partners are going to be there? Where are they located? Are they citizens? Like those different type of things will help you to choose the appropriate business structure. And that due diligence needs to be held before you pull the trigger in forming anything. Awesome. So the next topic is going to be much different than all of this, but I want to make sure if anybody has any questions that now is the time.
That was great. Thank you.
Excellent. Okay. That means I'm doing an okay job in explaining this stuff. I've only been reading it for the past 4 years, but
The LLC information was great.
Awesome. I'm glad that it can help. I'm glad it was of help. So the next thing we talk next, is real estate investing. Is that it? Yeah, real estate investing. So real estate investing there's a whole lot of different, things to know in terms of for real estate investing. It's actually something that I hold near and dear to my heart because I am an aspiring investor. Not an aspiring, I'm actually an investor. I'm in one of my properties, my only property, and I rent out. And so the things that I talk about here are also the things that I try to implement on my own and in building my own portfolio, right? The biggest thing I've learned about real estate investing is when you start investing in real estate, you got to understand that you are a business owner once you begin. Some people think there's a distinction between investor and business owner. They're actually like one and the same, right? It just depends on how you're going to be using that money. I'm going to speak from the perspective of a rental property owner because that's what I own. There are other, flips and wholesaling and, all these other different types of income that you can make through real estate, but I'm primarily going to focus on the rental game because that's what I'm mostly interested in, right? So for the biggest thing because I said that when you're real estate investing and you are, because I said that when you're in real estate investing, you're a business owner, you need to understand first the basics of business owning, right? And the basics of business owning of any business actually knows this, is accounting. Accounting is the eyes and ears of business, the link, and the, what's it, the eyes and ears of what? You know it.
I don't remember.
I forgot
Accounting
that.
is the eyes and ears. I don't know. A business. I don't know. Moving on.
I don't know. Yeah. What I'm trying to say is that accounting is the foundation of every single business. If you don't have good accounting, you will put yourself in such a disadvantage, and you won't be able to take advantage of all the things that are out there, right? Primarily, if you don't have your tax records and your accounting records in order, you can't file your taxes. It's the same. This is the same concept. What is your foundation? So in real estate investing, you need to know about all the business deductions that are available to you. That's primary. You need to know, you need to have tracked those business deductions so that you can take all the deductions that you can if that's what you want to do for that year, right? So when you purchase a property, and normally people will purchase the property through traditional financing means, through a bank, you're going to acquire a large loan, right? You're going to use closing costs. You're going to take closing costs on that property based on a loan, and that closing costs is going to include points that you might have taken. Those points are related to the reduction of interest for that loan that you're taking. If you don't know that, that's what points are. You buy interest down. Like, that's pretty much what it is, right? You're also going to have, all these other costs related. You might pay some property tax up front. You might pay some insurance up front. When you have a property that's fully rented and you're now living there, 100% of those points, property taxes, those mortgage interest payments, private mortgage insurance, repairs, utilities, operating expenses are going to be qualifying business deductions for you, right, on your business, right? That includes, so everything that you need to operate your business is going to qualify as a business deduction in a sense. Like anything that's necessary and ordinary, you need to be tracking as in your accounting to record it as a business deduction. Some people think that, if it's, I don't know if people understand what that fully means, or they don't see how deep it can actually go. But if you so I like to give good examples. So if you bought new thermostats or bought couches for the rental property, or you had a cleaning agency come in and clean it up, or you yourself went and bought blinds and put the blinds up yourself, you're going to be able to take all those deductions against any income that you reported. But with the deductions, you also have to report your income. That income piece is extremely important, because when you report your taxes on your tax return, they need to know that you're in business to make money. If you're not in business to make money, then you set yourself up for penalties, because the IRS. But one of the biggest benefits of real estate investing is the concept known as depreciation. That's going to be your biggest, your most important business deduction that you're able to take, because that depreciation deduction comes to you by no cash out, right? You don't have to pay money to receive that deduction. It's an expense that is incurred over time by simply holding your asset. Most of the time when we think about the depreciation, or people, I know, friends, they always think about depreciation. They think about a car when they buy it off the lot and they say it's $20K. And then when they drive it, turn the ignition, the car value drops to $15K or something like that. Often we say depreciation is bad and we don't like it. But when you're a business owner in real estate investing, depreciation becomes your best friend, because now you have an expense that goes against your income that you didn't pay for. You just waited. And that's tight. That's cool. Right. So if you bake that into your strategy, you'll see that when you buy multiple properties, you start building the depreciation, and then it covers some of your income that you're going to be generating from that properties. And that's and you might have heard the term of a tax shelter. That's essentially what real estate is, right? It covers your expenses. Does that make sense?
Yes.
Yep.
Cool. Okay. So the other piece of real estate is that real estate advantage is a home office opportunity, right? The home office deduction opportunity. This here, you don't have to be a real estate investor per se to take this advantage, but it's important to understand and to know. So if you bought a home and let's say you bought the home and you didn't rent it out, right? You were just living in it, paying your mortgage, which people do because you can take advantage of the equity build over time. But your property is not an asset or used as a business. So all of the expenses are going to be personal and not qualifying as business deductions. However, if you were to say, okay, I want to section out this portion of my house as a home office now, and I'm going to be running my lemonade stand business from this home office. And you actually could do that. You could say I sell lemonade, and you can have your separate home office. And when you do that, you essentially say this is a business, and now you're able to take up a prorated portion of the overall costs that happen in the home. Those overall costs are like, utilities, your lights, your mortgage payment, your interest, all the things we talked about, your points, your property taxes, your insurance, all of those are going to be able to, you're going to be able to take a portion of those things and report it on your tax return as a business deduction. You're also going to be able to claim all of the expenses related to setting up that home office, buying supplies, pens, monitors, computers, things like that, just to say that I have a qualifying business within my primary residential home.
So can you?
You can be a renter as well, right, Zoe?
Correct. So this applies for renters as well, and that prorated cost is just going to prorate the rent payment that you have, right? But that renter is not going to be able to take like the whole,
right,
like the mortgage, the property. It's just going to be the rent, and if they pay utilities, then the utilities, and even if they pay like grass maintenance, like it's your whole property.
Yep.
Right.
So I was gonna say, I don't think you got into numbers, or maybe you did, but your home office has to be a specific square footage, right?
I haven't seen that. Maybe.
Oh, Mom,
I just know
used
you
to
have
always
to.
tell me to measure.
Yeah.
So you can do your proration.
Yeah, you have to measure it. Like you have to measure it, so that you can say, okay, what is the total square footage of the house, and then what is the square footage of my home office, and then that's the percentage, the weighted average or the percentage that you're going to be able to take from your expenses. So you want to be precise. And if somebody comes asking, you want to be able to prove that this is a legitimate home office. Like I don't just set up this desk and just sit here and watch YouTube. I actually work here and actually do things here, right?
There can't be a bed in the office. Like,
no, hey, no, it can. See, like I have a bed right there, and this is my home office. But all I'm doing is I'm sectioning off where I'm actually working for the most part. Like, so from me all the way back there, I have just papers and books and things. This is my little square, like rectangular home office. So I just measured that a reasonable, space. I know that if someone comes in here and looks at it, they can be like, okay, that side of the room is personal because I see your bed and your dresser and all that other stuff there. So just measure it as accurate as you can be for the space that you actually use. Okay. The next cost, yeah.
I was just gonna say, for the sake of time, can we talk about a 1031 exchange and pass over the cap gain and probably the solar energy? I think the 1031 is a complex topic, so I just want to make sure you cover that one.
Okay. So yeah, let's jump over to 1031. So with the 1031 exchange, what that simply is just how can I say, is shifting the capital gains that you create from the sale of a real estate into a new opportunity, right? So in simple terms, I have a house that's $100,000 and I sold it for $150,000. That normally that $50,000 of gain is going to be subjected to capital gains tax, and that capital gains tax can be hefty sometimes. But in real estate, I think it stops at 15%. But to avoid that tax, what investors are able to do is to lump up that 100 plus that 150 and roll it over into a new property that costs 150 or something similar for similar use, right? And you're going to be able to completely avoid that capital gains tax and just pushing it out to the side. And that's really helpful because especially if you're a rental owner, most of the time you're not really worried about selling the property and making that type of gain. You want to make a consistent cash flow. So if you keep down your capital gains taxes, you're going to be able to satisfy that goal of yours. The actual form to filling out the 1031 is not simple. So you're definitely going to have to find a professional to do so, at least to dig into the nuts and bolts of making it actually happen. But it is definitely one of the bigger, more important strategies for real estate investing. Right? That makes sense? Ashley, you just tell me what you want to talk about.
I guess, is there anything else on here that anybody else would like for Zoe to hit on? I just know there's a few more topics and it's already 5:17, so, or sorry, 8:17 y'all time.
Yeah, I'd like for him to address the gig economy, so, most of us may not be in that economy, but we have family and friends that are.
Mm-hmm. Okay. Yeah. So the gig economy, sometimes I feel as though this is just I deal with this a lot because I'm what, 28 years old, and I have a lot of friends who have side hustles.
Yeah.
A lot of people who are basically doing side hustles. And the biggest thing that I try to do for my group of people or people in the same economy or so is to educate and consult. Right. So we at my firm consult people who have gigs or side hustles. But the biggest thing we try to do is to shift their mindset because we try to shift their mindset from believing and thinking that their side hustle is not a business, right? Mm-hmm. So what you really have to understand is not gig economy is just small businesses. So once you think about shift it and say, okay, I'm not just, selling pencils. I'm a business owner selling pencils. You start treating it differently, and then you start actually doing all the things that a business owner would do and should do, right? So you start thinking about business structure. Okay, I'm a sole proprietor because I haven't registered this or anything. What other things can I do to make it more efficient and stand? One of the biggest things that people need to understand, especially when you're doing gigs and you're working as contractors to anyone, is that oftentimes you're going to receive income that is not taxed, right? That 1099 income is going to just come to you. Hey, can you give me a service for $1,000? Yeah, I'll write you a check for $1,000. You do it. That person who paid you that $1,000 is not going to say withhold taxes from that $1,000. Based on your tax bracket, and then remit it to the IRS on your behalf. So this is where sometimes freelancers drop the ball and kind of shoot themselves in the foot, is because they take that money, that $1,000, and believe that, okay, I can just spend the whole $1,000. Rather, the responsibility for paying the taxes or your estimated taxes up front, or holding on to some of that money to pay your taxes on the back end when it's time to file your taxes, that responsibility falls 100% on you. And so when people are working at their W-2 jobs and then having a side hustle, they don't realize that their employer, when they're withholding those taxes on those W-2, the employer has taken the responsibility of withholding and remitting taxes to the IRS. So now you switch it up by becoming the business owner when you're running your side hustle. So you need to keep track of that income. What might trip you up is that sometimes when you receive that income, not sometimes, oftentimes if you're working with business to business transactions, another business will contract you to do work, give you the money, And then at the end of the year, they're required to report to the IRS how much income they paid you, right? So you can say, okay, I'm not reporting this because I don't want to report it. However, you worked. And so this company is going to report you because they have a legal requirement to do that. So you can't kind of escape it. So you might be building, you might have escaped it for a year or two, but you potentially might be building up, you know, a snowball that's ready to hit one of these years or so. And I don't want that to happen. So when I talk to people who are doing side hustle, I advise them, even if they don't know how to make estimated tax payments quarterly throughout the year, I say make 2 checking accounts for your business. And when money comes in, 1,000 comes in, take 30% of that and throw it into the second checking account, label it taxes, right? So that all your income coming in, you always throwing 30%, always throwing 30%. So by the end of the year, you're not going to be, you're going to be able to report your income comfortably, and you're not going to be, you know, caught off guard from a huge tax bill based on the income that you generate. That makes sense? That's cool?
So they also can, you know, track their deductions as well, right?
Absolutely.
To help offset those taxes.
Absolutely, absolutely. And that's where the benefit of having a side hustle comes into play, because like, you're not a side hustle, you are a full-fledged business. And the quicker and sooner you start thinking about yourself that way and considering that, shifting your mindset, the sooner you'll be able to take advantage of all of the, you know, benefits that are out there for all businesses, which is business deductions, right? One thing, one conversation I always have with people, that I've had with people a lot this year, is because is starting this process sooner than later, because you don't know what's going to be happening in the future, right? This whole year has kind of shined a huge light on businesses, right? When COVID-19 was at its peak and everything shut down, everyone was at their house. The funding that a lot of the funding that came was primarily focused on businesses. So people who, you know, put off you know, opening business accounts, or thinking that their side hustle was just a side hustle. They weren't making enough money to be a business. They missed out on free money, free opportunities for them, because they just didn't, you know, they didn't flip their mindset soon enough. So you don't want to wait until the next pandemic before you start, you know, flipping the switch, and treating your side hustle as a business, because you're gonna be missing out on opportunities that no one should really be missing out on, right? The other things you need to know about, so when you are running your side hustle, we're not even going to call it side hustle anymore. We're going to call it your small business. So things to keep in mind when you're running your small business is that, when you register, what's going to help you is to apply for an EIN number. That EIN number is going to be your business ID, like your social security number for your business. And what that's going to help you to do is you're going to be able to go to a bank and basically open up a business banking account. Now, why do you need a business banking account? Why can't I just use my personal account? One, the benefits for having a business bank account far outweigh the ones for like personal accounts. And a simple example, I applied for a business credit card that was $20K recently, and the interest rate on it was 5%. I would never be able to find that as a personal credit card. So that's just one. But two, it's not it. Two, you know, if another pandemic happens, when the banks shut down applications for businesses and aren't giving funding, they look at what business accounts are open. Your business is going to be open for some of that federal money, federal support happening. And then three, having that business account open is going to help you in your accounting process, which is foundational. We spoke about how your accounting process is super foundational. And one of the worst things you can do as a business is to commit what we know as commingling of funds. You know, as we spoke about, when you have those different segments of business, is your business is under one LLC, it's not a good idea to have those funds intermingling with each other without keeping good track of them. It's the same way for when you have your small business and you have your personal things. So you need, and it's highly recommended, have a business bank account, and then all your transactions, get a debit card at least for that account, and have all your transactions running through that account only, right? Even if you sucked at accounting and you didn't know what you were doing, as long as everything's over there in your business account, at the end of the year, you're going to be able to talk to a CPA and say, here's my account. Can you help me recreate my financial statements? And they're going to be able to do that with you fairly easily because it's already there. So that brings me to the next point about like accounting, right? So all of your information is going to be in your business account, coming to you based on your bank statements, right? Those bank statements need to be sorted and categorized so that you can have appropriate accounting. We like to suggest our clients to use verified accounting softwares that are well known and simple to use. Most of our clients use QuickBooks. I do know of people who use like softwares like Xero. And the more complex your business becomes, the more complex the accounting softwares can become because there's just so much to track. And why do you want to track that? Because business deductions are the name of the game. We literally just heard like a few days ago, our wonderful president didn't pay much in taxes. Was it because he was doing things illegally? No, it was because he was taking advantage of the business deductions that were available to him through real estate investing, right? And you don't want to be the only person missing out on those opportunities. The other thing you need to think about is when you are working as on your own business and you are contracting with other companies, you might start seeing some W-9 reports coming to you during your business dealings. Sometimes I have people come and they be like, I don't know what a W-9 is. Why do I have to fill this out? Right? That W-9 is one, if it's not a requirement for that company to accept you as a contractor, it's going to help them to essentially take your information so that they can report to the IRS properly at the end of the year. They're going to say, I contracted with Ashley McCullough. Her name, this is her business name. This is the business structure she is. This is the EIN number she has, and this is the address she has. So whenever I send her money, I record it, and at the end of the year, this is the person who I paid, and that's how they're going to keep track of that. So you want to make sure that you are actually you're not only filling out your W-9s for the people who give it to you, but when you start working with other people and hiring them out, you also give out W-9 forms so that they can give you that information. And those W-9 forms are easy. They are online. Google it. They're free and blank and available at your leisure. So I kind of hit on a lot about gig economy. Are there any questions? Anything I can elaborate on?
So there was another slide that it said something about the 20%, and then it said something NI. I just wanted to know what that acronym was for. Yes.
Okay. So this is qualified business income deduction, and that's 20% of net income. So I believe as of I don't know what year, it might be 2018, because it might be 2018 because I think it might have come through the Tax Cuts and Jobs Act. So businesses that are under a certain amount, a dollar amount of net income or revenue or something, they're able to take automatically 20% of their net income as a deduction. So you can add that under business deduction. So it's to help and assist small businesses. So even if you had that, that side hustle that you're calling a small business, this is also available to you. And this is a game changer.
And do you deal with Dun and Bradstreet numbers and accumulating credit that way as well? I just wanted to put that out there because I'm going through like all of okay, let me get all my ducks in a row right now. And So I'm like, oh, well, I don't have to use my personal credit to build my business credit if I have a Dun & Bradstreet number. So I just wanted to know if you, have any info on that.
The only info, do I deal with it like on a deep basis? Not so much. But I do know that building your business credit is simply just doing that, building business credit. And it starts off with applying for business credit. Like that report, that credit card that I said I applied for my business is the first record for my business of having credit. So now just the simple fact that I have open line of credit written to the name of my business allows me to have a Dun & Bradstreet number, right? And so what I've read and heard and learned about is just you simply have to start opening lines of credit and having activity with your business name on it to start building some credit history. It might be difficult at the beginning to get started because not many people are going to just give you credit, but your banks sometimes, if you had an existing business bank account, you can start off with a credit card. And so now when you also, the other thing is that sometimes the businesses that you contract with will report your credit history to Dun & Bradstreet, right? So we have, even from our example, we have clients in the past who just simply up and said, we don't want to pay you anymore. And sometimes that's, as a business owner, that's a scary thing, because it's like, okay, you can't go to somebody and like, mafia style them and tell them, pay me my money or so. But one of the ways that you can retaliate is reporting that open line of credit to, or that what is it called? That credit that they owe you to their Dun & Bradstreet report, and it will hurt their credit score in a sense. So I really think it's more of a just business to business reporting, almost like a rating for how we contract with one another.
And so, Sonia, once you register your business and start they will come looking for you. You'll get mail, you'll get offers, it'll come to you.
I just, my only thing was I didn't want to use my personal credit for that purpose. And my brother and I, we're partners. So he was saying, well, hey sis, we actually can go to like Office Depot, Lowe's, Home Depot type deal, and we can go there and build our credit, because they'll actually give you lines of credit based upon your Dun & Bradstreet number.
Yeah, and so the personal point, like you still might have to give your personal credit score at the initial stages, because at the beginning the business has nothing other than you're the one under it. But I think once you're able to have that credit and establish that Dun & Bradstreet report, you no longer have to talk about your personal side. It's just kind of just started off, right? Yeah. Cool. I only have one more slide that to talk about the 401k withdrawals, which is something I kind of learned a lot about today because I was on the phone with a couple people. But we can talk about any other questions that anybody has if you don't want to go here.
Well,
I just wanted to.
Go ahead, whoever.
No, I was just saying, I just wanted to be mindful of the time. I know the debate comes on at 9, presidential debate, so I don't want to overlap with that. But Mom, what was you gonna say?
No, I was gonna say, if anyone has to drop off, by all means. But if anybody wants to, Zoe, if that's okay with you,
that's fine with me.
If you have that additional time, but we do understand if anybody has to drop off.
And it's also being recorded, so everybody will get a copy at the conclusion of the meeting.
So Zoe, I'm glad you're at the 401k. So if you would specifically, when you get started, address the withdrawal within the COVID relief.
Okay.
Okay.
All right. So with the 401k withdrawals, okay, obviously I'm not a broker for for retirement accounts, so most of this information is definitely coming secondhand. However, during this time, I would start off with the COVID one because that's important. That's probably what we're most interested. How do I access my 401k money without, you know, and still avoid the penalties without paying those penalties? And how do I use it for my business or use it for investment, and vice versa, right? So what I've recently learned is that you can withdraw, depending on, regardless of the type of 401k, like vehicle, traditional or Roth IRA, you're going to be able to withdraw up to $10,000. Oh, this is to use for a primary residence. There are other qualifying purchases that you can use, that $10,000 withdrawal on, that allow you to avoid that early withdrawal penalty. That early withdrawal penalty is usually 10%, and you're going to be paying that when you pay your taxes, in a sense. So that withdrawal penalty is 10%. But if you're able to avoid that penalty when you make the withdrawal for a qualifying purchase, you're still going to be subjected to the tax related to that income, right? So you're not going to be able to avoid the tax, but you're going to be able to avoid the penalty. So that's I'm gonna say. So now with COVID running around and causing hardships for most people, they have opened up that 10K withdrawal to anyone that's suffering from hardship with quarantine things happening. Do I know all of the requirements for it? No, but I do know the biggest thing is being able to prove that you or your business had suffered through from the quarantine and shutdown and all this, the environment that we live in. So you're gonna have to know that you're gonna have to prove it. What are some ways? If you had a client that told you that I can't pay you because I don't have any money, take a screenshot of those conversations. If you have good accounting, you can show that your income had dropped for that period in time. You can see that you didn't have that much revenue coming in, and you can also keep track of letters that came from your from businesses that you work with, or even from your banks that acknowledge that you have suffered from some type of hardship during this time. And that's going to bolster up your case to be able to qualify for this distribution. The distribution, it allows you to avoid the penalty, right? I don't believe it'll help you. It'll allow you to avoid the taxes related, but that's also. I don't know if there has been like I'm gonna say an official statement from the government stating whether or not there might be credits or deductions related to COVID coming into the next year. However, you at least are going to be able to avoid the penalty and not the income tax. The ways you withdraw from your account. So those two ways we just spoke about: the 10K withdrawal for qualified purchases, and then the hardship relief withdrawal. Those are simply just withdrawals and are accounted to you as income to you personally. The other way to take out of your 401k is through just a personal loan to your 401k. So there's only two real ways to do that. So that loan piece is exactly what it is. It's a loan to yourself. So you loan yourself 10K out of your account, and then you're going to be paying yourself back principal plus interest. So short term, it might be a burden for you to hold on to, but long term, you're actually adding money into your account because you're paying that interest. One thing I found interestingly, that was an interesting distinction between the traditional IRA and the Roth IRA, is that since the Roth IRA, and I assume that everyone knows what the traditional IRA is versus a Roth. Yay, nay? Or should I just explain it?
Yeah, but you probably can go ahead and explain it.
Yeah. So the traditional IRA is an investment vehicle for retirement that's contributed, that when you contribute to that investment vehicle, it'll be pre-tax dollars. But Roth IRA, you're going to be contributing to that investment vehicle post-tax. So after you paid your taxes, you're going to be contributing there, right? So let's say you contributed to your IRA, your Roth IRA for the last 5 years, and you put in 10K, right? You put in 10K money, amount of contributions. but your portfolio or your account increased to 20K, right? What I know is that with the Roth specifically, you're going to be able to withdraw that initial 10K that you have put in over the span of 5 years. You're going to be able to withdraw all of that tax-free and penalty-free. Why? Because the money went in post-tax. Tax was already paid on it, and it's your money, so it's not gain. So you're going to avoid all of the penalties related to that, right? Now, when you start withdrawing more than what you put in, that's when you start seeing that penalty come on board, come into play, as well as additional income that needs to be taxed come into play. So yeah, so those are ways that you can incorporate this into your investment strategy. For me, I know I've been putting into a Roth IRA, and so finding out this information makes me think, wow, I got extra cash I have quick access to that isn't going to increase my tax liability, and it's not going to incur an early withdrawal penalty for me.
Any questions there?
I just wanted to let y'all know I actually did this.
Yeah.
But I did it through the CARES Act. So
Okay.
you have until December 31st to do this through the CARES Act. And basically what happened is there's no penalties, no fees, nothing. I have to pay nothing on it, right? I can pull as much as I want actually out. And I can do this once a month until December because of a COVID-related hardship, right? So if that's the case, I didn't have to prove anything, by the way. They just, my particular company didn't make me prove anything. Okay. It was just a matter of me signing a document stating that I was pulling it for those reasons and that I understand that I could have elected to take all the taxes out right now. Yeah. But just due to the situation, it made more sense to pull it all because due to, COVID being the situation, pretty much everybody can claim hardship at this point, right?
Yeah, yeah.
I mean, let's not get crazy. I mean, I know there's some millionaires out there that really ain't got no hardship, but
yeah.
So I did it and they said, yeah, if you want to do it again, you're welcome to do it again. You do have to wait and you can only do it once per month. Okay. And I have 3 years to pay back the taxes on the funds. So I can do it next year. I can do it the year after that, but I do have to do it within the 3 years. I do have to pay the taxes back on what I pulled. So I just wanted to put that out there. It's called the CARES Act. And you just mentioned the CARES Act, and then they'll basically give you a document to sign stating you're pulling the money for that purpose. And they'll let you know that you can either pay the taxes now or later, but it is up to you. So, and it's very helpful, especially right now. I mean, you got to figure something out because you need to figure out, okay, what can I do that's going to be essential and necessary no matter what's happening in the world. So it's kind of helpful to be able to just have that ability to say, okay, well, I made this investment. What can I do with this investment now to maintain my investment in the foreseeable future, right?
Yes.
It's a great time that, if you need a lump sum of money, especially though you were talking about investment. I was working with a young lady. She actually bought 5 properties. She took the money out of her 401k and she was like, I'm living now.
Wow.
And so she'll more than pay herself back.
Yeah.
She decides to rent or sell, flip those at some point. So now talk to your plan administrator. Now could be the time that you could get ahead quicker than you ever would have, So do your homework.
I actually totally agree with that because I am self-employed right now, right? So I have a 401k that I can't contribute to anymore. It just sits there. And I was like, how do I get this money that I can't touch, right? And, COVID happened. So I might be able to withdraw all of it and just flip it into a real estate investment.
Mm-hmm.
And another thing is you can also roll it. Because let me tell you, I wasn't very financially savvy when I first got my 401k. And the type of 401k that I got was one where I had to choose stocks, right?
Yeah.
So once I stopped working at the company, those stocks are still mine, and I'm still getting money on them, and I had no clue. So I was like, oh, I gotta get all my finances together, and I really had to like put forth the effort because I'm really bad. Like, I ain't gonna tell y'all how bad. It's bad. And usually I'm just like, oh, whatever, la-di-da, it's money, whatever, because I like, and I've mentioned this previously in conversations, but my parents weren't able to teach me because they didn't have the tools.
Mm-hmm.
And they had no idea what they were doing. So I have to figure it out for myself to create the generational wealth at this point, right? And I went to look at, all my documents, and I was purging, and I went, wait a minute, is this for real? Do I really have money?
Yeah.
And so I went to look into everything, and sure enough, I had like 2 different IRAs going on that I had no clue. And one of them, I had 3 different stocks.
Yeah.
And one of those stocks, I can't even get if I wanted to. It's not open to the public. It's part of being it's a part of that company.
Yeah.
So what I did was I just said, you know what? I'll pull some of it and I'll let the rest just keep moving. And I did, and it continued to move. I said, well, shoot, keep moving for me then. I'm good.
Yeah.
I'll just keep y'all right there where you are.
Absolutely.
But I had no clue, but you can always roll that into some stocks too.
Yeah. Absolutely. Absolutely. Yeah. I had stories of people who've worked 20 years in different companies having 5 401ks, and they're just sitting there growing, and they didn't even know.
Yeah.
So, yeah, that's pretty much all for me. That was all my slides. The other last thing was just Q&A, which we've already done, or, if you wanted to contact me or get for more information about me and my firm, you can visit our website, ONO CPAs. You might catch one of our commercials on that page, or if you want to call me up, my number is right there. Or if you want to ask Ashley how well of a student I was at A&T, she's right there.
Ashley, how well of a student was Zoe?
He was one of the bright ones. It was him, sadly.
Well,
yeah, that's like, I think he definitely made that apparent. I appreciate you. Thank you very much, King. It was amazing. And so let's say I was like, hey, I need a CPA, right? And you're in Maryland, you said?
Yes.
So is that going to be an issue? Because I'm actually relocating. I'm going back to, so I'm going to Cali. So would that be an issue for you to be dealing with another state?
Oh, no, not at all. Like 100% of our clients are virtual states. And we already work in 3 different states just by virtue of being in Maryland, DC, and Virginia. So,
right. Tri-state. Okay. And okay, so I meant to ask this question, but are you familiar with people starting their LLCs in other states and what the benefit would be there? Because so Brian, who's normally on the call, he wants to start an LLC, but he wants to do it in Nevada because he's heard that Nevada has more security for the owner. Mm-hmm. But I'm not sure what that actually means because I've also looked it up and checked it out, and it said, you shouldn't get an LLC in a state you are not residing in. But I don't know what the benefits or, like pro-con situation would be to obtaining an LLC in a state that maybe has better, I don't know, just keeps you less liable, should I say, right?
Yeah. So, there's a lot of things to consider when going across state lines to register your company. You got to really know, like, what does your company do and what is the goal for it? I know that there are certain states that are more landlord friendly. And so clients want to have LLCs in those states to hold properties in those states, if you're talking about real estate investing particularly. But the thing that people don't always realize is the paperwork involved with each state. Like, it's its own thing, right? So if you have if you have the LLC in a different state, you got to make sure that you're on top of it for whatever that state requirements. And there's 50 states, and they all have their own separate like requirements. So you just want to make sure that you're doing the necessary research for that state and how to maintain the LLC. One thing I do know is that when you're going to a different state, you also need to have a resident agent for that specific state. That could be an issue sometimes, right? You can either pay somebody to be your resident agent, and they may have a recurring fee for you that's in addition to that annual reporting requirement or reporting fee that state might require. You can do that, but that also just might increase your overhead costs for just maintaining that. Some of the benefits I've seen for specifically that I think are, the only real benefit, a big benefit I've seen is mainly with like the amount of laws for, like the judicial system for a specific state, and whether or not it's the legal environment is kind to business that happens there. Like when I was auditing with Deloitte, many of the C corporations that we worked with were found or registered in Delaware, primarily because Delaware has a robust legal system around, C corporations, and it's not so stringent on how they regulate C corporations. But when I was trying to do it for an LLC, for me, I was like, it didn't really make so much sense because I'm not looking to sell stock eventually. And I don't want to also pay the extra additional cost just for the Delaware side. So it's really hard to say for every specific state, but I would say go to the state website, read into their regulations, and is their state friendly to the kind of business that you're trying to get into? And then are you able to cover the costs related to maintaining the LLC?
And would it, like you were saying, for real estate investment, would it even make sense to have an LLC filed in another state to begin with, and then you're going to be operating in a completely different state, purchasing properties and the likes?
Yeah, I don't even know if it's actually necessary all the time.
Mm-hmm.
Because I don't know if it's also necessary because you can still buy properties in other states regardless of where you are. So I don't know if the LLC itself is going to help like your chances on buying a property, but I do know you're going to be having to maintain documents for 2 states: the state that you actually operate in and reside in, and then the state that you're
doing business
in,
okay,
or you're legally structured in. And then you also got to think about whether or not you have nexus in those different states. And nexus is just the sales tax related to both of those different states. So there's a lot to consider. And I wouldn't say just because you hear most businesses register in Delaware, you say, oh, let me go register in Delaware. Those businesses thought about why they're going there, and it made sense.
Okay, wait, my last question. Sorry, guys. But it's not possible. So for instance, if you have a real estate company and you acquire multiple properties, right? Mm-hmm. Are those properties are not necessarily owned by your company, they're owned by a person. Is that correct? Like properties can't be owned by business, like by a business?
They can be owned by businesses for sure. You
How
just
does
have
that
to
work?
It's the same way as if you were a individual. You just have to have your business account, have the business registered, and then when your lender comes to you, they have to accept that you're signing on a dotted line as the business. All right. Your lender is going to have to agree with it, and the title company is going to have to put your business on that title. If they don't, then they're going to put your personal, right? But the thing is, sometimes the lenders may be hesitant to put your LLC on the business, right? If your LLC doesn't have a history of anything, right? Because they're going to want some security. So I think that's the issues that I've run into when trying to transfer ownership from my primary residence to my business. The banks who are lending have the power, and they require me to do a refinance, but I don't want to do a refinance because of the cost. But I just want to change the title. but the banks aren't that. Sometimes, depending on the lender, like you have to ask your lender. They're not always so sweet and say, oh yeah, just switch it over to an LLC that doesn't have any financial statements. So that's one thing. Oh, big thing that I forgot to mention about being in business for yourself and self-employment and applying for loans and things that I've learned about the hard way. When you are in business for yourself, you are going to, whenever you apply for a loan or mainly just for a loan and you're dealing in real estate, those companies or lenders are going to be asking you for a year or 2 years worth of tax returns to prove that your business is viable and can maintain the cost of the properties. We say, all right, so if you only had 1 year or less than 1 year, oftentimes you might experience being denied, even if your business was wildly profitable in the last 6 months. They're hesitant, especially during this time of COVID and quarantine. The restrictions for approving for mortgages can be a little bit more stringent. So if I were to go back and do it and do things, I would try to. Actually, I already did it, but if I were advising anybody who's coming up and they're still working their day job, and then looking to go on their own into real estate investing, I would say, especially if you're trying to get a home early, and maybe you're trying to house hack that house, I'd say get your house while you're working at your job, or try to start that process while you're working at your job, because you're going to need 2 years, or start your business and get it registered as soon as you can so you can start building that history, because that history is going to help you so much when you're talking to a bank and saying, I need $100K so I can buy this house. And you don't want to get denied like that because it doesn't feel that great. And they would deny you even if you have like 90% of the funds in your bank account, which baffled me, but that's what I learned the hard way. So.
Awesome. How y'all feeling? Y'all feeling good?
Very good.
All right.
Stupendous.
Yes. All right. Well, Zoe, if there are no other questions, and again, as you see, Zoe is very personable, so I would screenshot his contact information and get in contact with him one-on-one so he can work with you personally if you have any other questions. But until then, Zoe, thank you.
Thanks for having me. Thank you.
Thank you. Thank you for coming on here. I think this is very informational for everybody, and I think it'll be even more beneficial for the people who could not attend today. So
yeah,
we'll pass this along to them. But other than that, y'all have a blessed night. Mom, did you have any parting words?
No, I'm just really happy. And so you hit on something that we had our first meeting, and we were talking about take care of your business, get your bank accounts set up.
Yeah.
Get a good accountant and a good lawyer if you're trying to do real estate or whatever.
Yeah.
And a lot of people missed a lot of money by not having their bank account set up.
Mm-hmm.
When the CARES Act distributed all this money, and a lot of the click of the button, to get some of that money. So again, good advice to have your business affairs ready to go. Because there is a lot of money out here.
Yeah, it is. I'm trying to eat. I'm trying to get some.
Right.
Well, now you know a Black accountant. So if you need somebody, you have the plug, support Black-owned businesses. Also one of my good friends. So y'all have a blessed night. Y'all be safe. Zoe, I'll see you in November. And talk to y'all, 2 weeks?
Thank you, young Black mogul.
Good
Take care.
night, y'all.
Night, everybody.
Peace and